Hello! Today we will be covering the specific identification method for calculating cost of goods sold and ending inventory. The specific identification method can be used when the cost of each item in inventory is individually kept track of and can be matched to a sale on a specific date. For example, if I own a car dealership, it's relatively easy for me to keep track of how much I paid for each car on my lot, since the item I'm selling is large and I probably have relatively few sales per day. This might be done by keeping track of the serial number, which is unique to each car. So specific identification might be a good inventory costing method to use if I was running a car dealership. On the other hand, if I was selling paper towels, let's say, I probably sell quite a few packages each day, and it would be a lot of work to keep track of when I got each shipment of paper towels and how much I paid for them. So an inventory costing method other than specific identification might be a better choice. Now on the bottom right, I have a list of which units were sold and when. This is extra information that needs to be provided in order to complete a problem using the specific identification method. On the right, I have a list of transactions that the company was involved in, including purchases and sales. On the left, I have a chart where I will show my work as we complete this problem. There are 3 columns I will be filling out. First, we have purchases, which we will use only when the company purchases new inventory. I have a plus sign here because new purchases add to our inventory. The next column is COGS, or cost of goods sold, and we'll use this column anytime the company sells some of its inventory. I have a minus sign here because sales subtract from our inventory. The third column is inventory, which is where we will keep track of how much inventory the company has as of the given date. We need to add to the inventory column anytime there is a purchase, and subtract from the inventory column anytime there is a sale. Our first piece of information is from January 1st. The company had 500 units of inventory, which they had previously purchased for $10 each. Since these units are part of beginning inventory, we can place them in the inventory column. Now, some instructors will have you calculate the inventory balance at this stage, taking 500 times $10. But in this video, I'm going to wait until the end to do any calculations. Next, on January 2nd, the company purchased 300 units at $11 per unit. Since this is the purchase, we can put it in the purchase column. Since there were no sales on this date, we can skip the cost of goods sold column. Now, we always need to fill out the inventory column. On January 1st, we had 500 units at $10 each, and since there were no sales, those units are still in inventory, so we can copy them down for January 2nd. Additionally, 300 units were purchased at $11 per unit, and since purchases are plus, we add them to our inventory column. In order to make the rest of the problem easier, I'm going to highlight our chart based on our inventory cost. So let's make the $10 per unit inventory yellow, and then let's use green for the $11 inventory. Next, on January 7th, we have our first sale of 640 units. That means we get to use our cost of goods sold column. Since the column is titled cost of goods sold and not price, we can't use the $35 selling price here. Instead, we have to use the additional information in the problem to help us determine the cost of goods sold. Now, if you were using FIFO or LIFO, you would look at your inventory balance and apply the relevant procedure to find the cost of goods sold. And if you were using the weighted average method, you would find the average cost of all inventory as of the sale date. But we are using specific identification in this video, which means the company has kept track of exactly which units were sold on this date, which is given in the additional information. We are told that the January 7th sale consisted of 480 units from beginning inventory. So if you look back at our chart, we see that the beginning inventory units were $10 per unit, and we colored those ones in yellow. So we can copy down 480 units at $10 a unit for our cost of goods sold. And then we have 160 units from the January 2nd purchase. Well, those were the green units at $11 per unit, So we can list those in our cost of goods sold column as well. Now we need to calculate the January 7th inventory balance. Since cost of goods sold is a minus, we take our previous inventory and subtract anything that we sold, one layer at a time. So that's 500 yellow units at $10 each, minus 480 yellow units sold equals 20 yellow units remaining. As for the green units, we can take the 300 from our previous inventory and subtract the 160 sold to get 140 units remaining. On January 11th, we sold 120 more units. Since we made a sale, we will be using the cost of goods sold column. The additional information says that the January 11th sale consisted of 20 units from beginning inventory and 100 units from the January 2nd purchase. So we can use the units from the relevant dates in our cost of goods sold column. So that's 20 units from beginning inventory. Those are the yellow ones at $10 per unit. And 100 units from the January 2nd purchase. Those are the green units at $11 per unit. Now we need to calculate the January 11th inventory. Since cost of goods sold is minus, we take our previous inventory and subtract anything we sold, one layer at a time. So that's 20 yellow units at $10 each, minus 20 yellow units sold equals 0 yellow units remaining. Since there are none left, we don't need to list them in our inventory column. As for the green units, we can take the 140 from our previous inventory and subtract the 100 sold to get 40 units remaining. Next, on January 19th, we have a purchase of 400 units at $13 per unit. Since we have a purchase, we can record these units in the purchase column. Now we need a new color for the $13 per unit inventory. Let's use orange. Moving on to the inventory column, on January 11th, we had 40 units at $11 each. And since there were no sales, those units are still in our inventory, so we can copy them down for January 19th. Additionally, 400 units were purchased at $13 per unit, and since purchases are plus, we add them to our inventory column. Next, on January 21st, we have a purchase of 110 units at $15 per unit. Since we have a purchase, we can record these units in the purchase column. Now we need a new color for the $15 per unit inventory. So let's use blue. Moving on to the inventory column, on January 19th, we had two layers of inventory, green and orange. And since there were no sales, those units are still in inventory, so we can copy both of them down for January 21st. Additionally, 110 units were purchased at $15 per unit on this date, and since purchases are plus, we add them to our inventory column. Finally, on January 23rd, we sold 510 more units. Since we made a sale, we will be using the cost of goods sold column. The additional information says that the January 23rd sale consisted of 20 units from the January 2nd purchase, 400 from the January 19th purchase, and 90 units from the January 21st purchase. So we use the units from the relevant dates in our cost of goods sold column. So that's 20 units from January 2nd, the green units at $11 each. Then 400 units from the January 19th inventory, the orange units at $13 each. And finally, 90 units from the January 21st purchase, the blue units at $15 each. So we can fix these colors really quickly. Now we need to calculate the January 23rd inventory. Since cost of goods sold is minus, we take our previous inventory and subtract anything we sold one layer at a time. Maybe this is a good time for you to pause the video to see if you can figure out the January 23rd inventory on your own. Okay, the correct ending inventory is now showing in the chart. If you had any issues, the calculations are also showing on the screen now. Okay, we have done the hard part. All that's left to do is to calculate the cost of goods sold and the ending inventory. To calculate the cost of goods sold, we simply multiply the units and the cost for each row of the cost of goods sold column and add them together. So that's 480 times 10 plus 160 times 11 plus 20 times 10 plus 100 times 11 plus 20 times 11 plus 400 times 13 plus 90 times 15 equals $14,630 for cost of goods sold. Thankfully for our inventory, all we have to do is calculate the balance as of the final date. So that's 20 times 11 plus 20 times 15 equals $520. So technically we are finished. The cost of goods sold is $14,630 and the ending inventory is $520. But there's one more step we can take to check our work. We can calculate something called the cost of goods available for sale, which is simply the beginning inventory plus all purchases. So that's 500 times 10 plus 300 times 11 plus 400 times 13 plus 110 times 15 equals $15,150. Now if we take the ending inventory of $520 and add that to the cost of goods sold of $14,630, we get, well, $15,150, the same as the cost of goods available for sale. So that's a good way for you to check your work, and it works regardless of which inventory costing method you are using.